Welcome back, options traders. Happy Friday to everyone. Well, I keep getting questions by email from traders asking, do technical indicators give you an edge? And we've covered this in roundabout ways in previous videos, but let's cover it again because it seems to be a pervasive question. Everybody wants to know if these technicals or moving averages, candlesticks, whatever, give you some type of an edge. Well, it's a good question. Let's go find out more. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So let's start with the most obvious. Let's define what is an edge. Whenever you hear traders talk about an edge, it's the same idea as if you're talking to gamblers or poker players. Lots of different fields all want to know if you have an edge. And that just simply means that there is a mathematical bias in your favor that is going to allow you to win in the long run. Doesn't mean you're going to win 100% of the time. That would be way too good to be true. You wouldn't even form a market because nobody would want to take the other side of the trade. But the edge comes in the fact that we can maybe find some type of a bias that is going to give us a long-term advantage. That's what an edge is. Now, depending on the games that you're playing, if there is an edge available at all, they can vary. And they might be positive, meaning that they're in your favor, or negative, that they're acting against you. So to really understand an edge, let's go take a look at a casino and the game of roulette. So in the game of roulette, there are 38 spaces on a wheel, at least for a US version. And if you bet on a single number, they will pay you off at 35 to 1. So for every dollar that you bet, you're going to win 35. If you bet on two adjacent numbers, just place your chip right between them, they will pay off at 17 to 1. 3, you place it on the row, it's called a street bet. 11 to 1, 4 is a corner bet, 8 to 1, and so on. There's lots of different bets. These are not all of them at all. But let's just pick one for an example. I'm going to pick this one up here, partly because it also emphasizes another fallacy that traders have. They'll look at this, let's say 35 to 1. And they'll make comments in the trading world like, oh, I like this strategy better because I have a 35 to 1 risk-reward ratio. Or I have a favorable risk-reward ratio because I'm only risking $1, but I can win 35. It's another fallacy. They feel it because it's skewed that somehow it gives them an edge. But an edge has nothing to do with the payoffs. It has to do with whether it's fair or not to the buyer and the seller. So to show that there's an edge against you, a negative edge at a casino, let's just concentrate on the single number bet. One way to prove that is, let's take $38. Remember, there's 38 spaces on the wheel, and we're going to get 38 $1 chips. Simply walk up to a roulette wheel and cover the entire board. Single number. So obviously it's going to win. So the question is, how much money did you make? Well, obviously you win, so you're going to collect $35, and the casino will return the $1 that you bet. You don't lose that dollar if you won the bet, so you get a total of 36 bucks. And there you go. There is your big $36 gain. The problem is that you spent $38 to play. So in total, you lost $2 of your 38, or about 5.3% of your money. That 5.3% figure there is the house edge for the casino. That's why they are able to build such lavish hotels and casinos in places like Vegas and Atlantic City, because of these edges that are against the players. Of course, you could certainly walk up to a roulette wheel and end up at the end of the night or a short term, but you're not going to end up in the long run. So the first thing to take from this is that there is a very big difference between having a high probability of winning, in this case 100%, versus having an edge. The probability of winning is a completely different topic from having an edge. And that's, again, something that a lot of traders miss. They all talk about these technical indicators, and they'll say, well, it gives you a very high probability for success. Well, if that's true, remember, everybody knows it. Nobody's going to take the other side of the bet. So to see why this works, why there's an edge against you, we can look at it mathematically. You have a 1 in 38 chance of winning the $35 prize, And so we just take 1 divided by 38, multiply by $35, and that gives us this 0.9211 figure. Well, if there's 1 in 38 ways to win, there must be 37 out of 38 ways to lose. So we take 37 divided by 38, multiply by negative $1, because you're losing $1 for every 35 you can win, and we get minus 0.9737. So we add up these two numbers, the red and green, and we get 0.053. And that's exactly where that number is coming from. So notice we can look at this a different way. There are 37 ways to lose for every one that you can win. And so because the odds are 37 to 1 against you, the reward should be 37 times bigger. So for every dollar you bet, the reward should actually be $37. But what does the casino pay? It pays $35. So there's your culprit right there. The casino pays off at less than fair value. That's the key, and that turns out to be really important. So even though it might look like a phenomenal risk-reward ratio that you hear a lot of traders talk about, it's not phenomenal enough. To make this fair, it should be 37 to 1, and then this number right here would be 0. But the fact that it's negative is how you know you're in a real casino. So if you were to play this over and over, betting on a single number, there's your outcome. You are absolutely going to end up in the negative in the long run. So here's 3,000 attempts. Now you can see that in the short run, you might be able to buck the odds and end on the winning side. But you're not going to do it over here. In the long run, you are absolutely going to lose if the casino pays off at 35 to 1. Now it also turns out it doesn't matter which bets you take, or at least almost. So if you bet on the single number, as we figured out before, minus 0.053, edge against you. If you bet on two numbers, you've got a 2 in 38 chance to win the $17 prize, and therefore 36 out of 38 ways to lose your dollar. And so we divide these out, multiply them together, and we add them up, and what do we get? Minus 0.053. And that's actually true for all of the bets at roulette, at least almost. There's another bet called the 5-number bet or the basket bet, which is betting on the top 5 numbers, and that's going to carry an edge about 8%. So remember, if you're going to play roulette, the only strategy you need to know is to avoid the 5-number bet, and you will lose your money equally fast. But now what if Vegas wanted to make it fair? Well, as I said before, they would need to pay off at 37 to 1. What if they paid off at 38 to 1? Now this is what you're going to look like. See, now you would have an edge in your favor at this price, or at this reward relative to this price. That's really one of the points of this video, is that it's not just about the price, it's not just about the reward, it's the reward relative to the price relative to the probabilities. And unfortunately, too many traders just look at one of the three. I have a high probability of winning. That tells you nothing. Or we have a phenomenal reward. That tells you nothing. Or it's really cheap. I'm not risking a lot. That tells you nothing. We have to look at what are you paying relative to what can you win relative to the probabilities. So why do I tell traders to not worry too much about the technicals? Well, remember, everybody can see them. If you go to Vegas, you'll see that they actually show you at roulette what's called a tote board. They'll show you the past 50 spins and which colors have come up and whether they're odd or even. They'll tell you all of that stuff for free just to keep you glued to the roulette wheel, just to make you think that you have an edge by being able to analyze this stuff, exactly like stock traders do and options traders. But as I showed, even if you cover the board, you're still going to lose. And that's why having a high probability for success isn't going to help you. So in the stock market world, here's what happens. Let's look at a different game. We've done this one before. If we put 10 numbers into a hat, and let's say that I allow you to win on the numbers 1 through 8. All right, well, you've got an 80% chance to win. And this is where a lot of traders, if this were a trading game, would say, oh, I've learned about this great strategy where you can win 80% of the time. or it's a great technical indicator that allows you to win, or it predicts 80% of the times correctly. And part of what I'm trying to show is that that by itself isn't going to help you. So if we were to put all of these numbers into a hat, then you can see that there are 8 ways to win and there are 2 ways to lose, or in gambling jargon, we would say there are 8 to 2 odds in your favor, or 8 to 2 on. We can, of course, reduce that down to 4 to 1 odds. For every 4 ways you have to win, there's 1 way to lose. And so what is that going to do to the price of this bet? All right, so think about it. Everybody can see that there's an 80% chance to win. The buyers see that, and so do the sellers. You're sitting here thinking it's a great deal. Oh, I should go buy it because I get to win 80% of the time. Well, what seller is going to want to take the other side and win only 2 times out of 10? Nobody. You have no market unless we can change the price. And that's the thing that all of these traders miss when they start talking about the benefits of all of these technical indicators and the high probabilities that they have. See, the mistake that traders make is they assume that every single bet or every single options trade out there is to bet $1 and to win $1. They assume that it's always a 50-50 shot. And so if they suddenly have an 80% chance to win, that they've got this great edge. No argument. If you can find an opportunity where you can pay $1 to win $1, but you're going to win 80% of the time, take that as often as you can get it. But remember, think about it sensibly. Who's going to take the other side of the bet? For anyone who tells you that it's not really true, you want to find these edges. Well, if you know where the edges are, so does everybody else. And again, ask yourself, who's going to take the other side? So in a case like this, yes, if there's a 50-50 shot, let's say with a coin flip, it's going to be bet $1 to win $1. But as soon as we change the probabilities, this is no longer true. So in the hat game, remember, you could win 80% of the time, or 4 to 1 odds in your favor. So if you think of this as a seesaw, and it's balancing right here on price, this is the function of price. But as soon as the odds go 4 to 1, what happens to the balance of the seesaw? Suddenly now the left side is 4 times as big as the right. Everybody can see that. If you're boasting about, I can win 80% of the time because of this technical indicator, the sellers know that too. Don't fool yourself into thinking you're the only person who knows that. If it's out there and it's widely known, that's always what cracks me up. People say, oh, it's widely known. Well, if it's widely known, how is it going to benefit you? What's going to happen is that the market is going to adjust this price. And the only way that they're going to get this to balance, if this left side is 4 times as big as the right, is that the amount that you have to bet would have to be 4 times as big. That would be fair value. That you would have to bet 4 to win 1. That's exactly what it means when there are 4 to 1 odds in your favor. So notice over on the left-hand side we have $1 that you can win times 4 is 4. Over on the right we have that you have to bet 4 to win 1. 4 times 1 is 4. It's in balance. And once it's in balance, this is what you can expect in the long run. You're just spinning your wheels. There's no reason to really take this bet. After commissions, this black line is actually sinking. So sure, if you want to trade on technicals and think that you have an edge, you can have pockets of moments here where you win. That's just random noise. You can also have moments where you lose. Don't fool yourself into thinking that it was maybe good markets here, that you were more in sync with the markets, and now just having a streak of bad luck. It's the nature of randomness. If you're trading at fair value, in the long run, you're going sideways. In the options market after commissions, you're sinking. So the main thing to take from all of this, for everybody who keeps emailing asking about which technical indicators give you an edge, remember, if there were even an answer that I could give you, everybody must know that. That's why there's an answer to the question. Everybody knows it. And if you're trying to find the indicators that allow you to win, let's say 80% of the time, everybody knows that too. and that means it's going to get baked into the prices. So the main thing to remember, if none of this still makes sense to you, always remember this. You can't beat the averages by doing what the average trader is doing. And yet that's exactly what you're trying to do by hunting down these technical indicators and saying that I've got an edge. That's assuming that you're the only person who knows, when in fact, everybody knows. And if everybody knows, it will get built into the prices. So what's the point of all of that? Well, if you're trying to make things easier by discovering technical indicators that allow you to win more often than you lose and give you some kind of an edge, you're really wasting your time. If there were such indicators, everybody knows them, and that means the edge is gone. So the better way to approach the market is to say, how can I set up my strategies so that I can hedge risks that I don't want, I can capture rewards that I am after, and how can I account for direction, magnitude, and speed in options when I'm setting up my strategies? That's going to go a lot further than trying to make things easy by figuring out which technical indicators give you an edge. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.